Good evening, everybody, and welcome to the January 2024 Investing Roundtable. This is Ken Kavula of the Mid-Michigan chapter of Better Investing, and I'm joined tonight by two of the original knights of the roundtable and one of our damsels who's helped us out innumerable times in the past 10 or 15 years. Kim Butcher, she's off to the far left on your picture screen there. That's me next to Kim. That's Mr. Groundhog in charge of the whole group right there. Cy is next to Mr. Groundhog, and that's Mark Robertson on the far right there. These voices should be very familiar to those of you that attend the roundtables on a regular basis. So without further ado, let's get through some of the tedious kind of stuff so we can get to the fun stuff, okay? This is an educational demonstration. We're going to mention real stocks in real time. We're going to try to tell you if we own these stocks. The views that we express are our opinions, and we expect that our audience is smart, and we expect that our audience works hard and that they will do their homework before they make any decisions about buying or selling or even holding any of the stocks we talk about. If you're new to the roundtable and would like to be on our reminder list, if you drop an email to nkavula1@comcast.net, that's my wife, Natalie, and she will walk you through the process of getting you listed on our guest list. And that way you will get an email once a month reminding you that the roundtable's coming up and giving you a registration link right in that email. If after you listen to the roundtable, you want to listen to it again, we post all of these things on our YouTube channel. There's lots of different ways to get to our YouTube channel. The fastest way would be to search Manifest Investing Roundtable. That's the fastest way, but Better Investing Roundtable works. Roundtable works. It's just that you get a lot of other things when you use some of the other search criteria. If you'd like copies of the slides in PDF form, you can drop an email to Mark or to myself. Those are our email addresses at the bottom of this screen. The fastest way to get the slides is to do it with Mark R. at manifestinvesting.com. We're both open to answer questions, and we just want to remind you that we're both volunteers for a program like this, and sometimes volunteers don't sit all day at their computers waiting for you to ask them a question. So we'll get to your questions just as quickly as we can, and we'll try to give you honest answers. And if we don't know the answer, we'll try to find it for you, or we'll be brave enough to admit that we're stumped, okay? Let's go to the next slide, Mark.
All right, Ken, I did just want to point out that Punksy Phil is here to remind you that Valentine's Day is 2 weeks and a day from now.
We're celebrating the Groundhog because Manifest Investing has its birthday on Groundhog's Day. That's February 2nd. And so you'll see a number of references tonight to Mr. Groundhog. Here he is peeking out of his hole in is it Punxsutawney, Pennsylvania, right, Mark?
That's correct. That's on our bucket list of places to visit. And we refer to this as our Groundhog Creed. We have an annual stock picking contest that goes from Groundhog Day to Groundhog Day. And this is the creed, and of course the lessons of Graham. That would be Benjamin Graham, David L. Babson, and George Nicholson Jr. George was one of the originating founders, often thought of as the grandfather of the modern investment club movement. And we just think that if we do the things that they have encouraged us to do, it really does increase the chance for success.
Our goal when we started doing this almost 14 years ago was to prove that creed. And I think we're going to make you feel proud of us, and we're going to be very proud of each other in just a couple more slides. Mark has given us something to think about. He likes to put a thought for the day on a slide occasionally. And here's a great thought from Proverbs.
Yeah, and it's just simply a reminder that we're better together, and we learn from each other. And wow, does this experience has been so powerful. So Ken, here you go.
Here's that slide that's going to make everybody proud of the entire investing club movement. This is a group of amateur investors. We like to think that we're pretty good amateur investors. Cy has some financial background experience as a financial advisor. Mark has a little bit of background, having worked for Better Investing for a number of years and being involved in many, many investment clubs. I have the experience of being involved. Mark likes to say 36 investment clubs. I
I was
really
down
only
to
belong to
19.
4. You were down to 19. Okay, I only really belong to 4, but it's given me a master's degree in investing. And the rest of the folks that we have in our stable of presenters are pretty darn good stock pickers and pretty darn good investors. And Kim is at the top of that list, I'll tell you.
Yeah, and
Our goal is,
I was just going to say, Kim is a perfect example. I mean, Kim is a labor and delivery nurse. That was her career, and she really is quite gifted at discovering opportunity and recognizing it. So, welcome
I
back,
can chalk
Kim.
it up to having to recognize all the symptoms in the patient and having to interpret the data.
There you go.
All right, that's it.
our goal when we put this roundtable together, and it was put together quite a few years ago, was to achieve a relative return of more than 5%. Now, relative return is a real simple concept. You can use even better English to say we wanted to beat the market by 5 points. That's essentially what George Nicholson told investment clubs about 50 or 60 years ago when he suggested they should be able to return around 15% a year if they were really doing a very good job. He knew that the stock market average was 10% a year over a long period in history. That's maintained until the present time, by the way. And so he added 5 points to that, got 15, and said clubs should be able to do that if they follow the rules we're going to set down, and if they're really careful and really conscientious, if they have patience, and if they have some discipline. Right now, that plus 5% over the market is represented by that orange dotted line right there through the middle of the graph. And you can see that our most recent reading is a full point above that orange dotted line. Our overall rate of return since inception of our tracking portfolio, this is not a standard club portfolio. This is a tracking portfolio that keeps track of all the choices we've made, and it does allow us to freeze a position, in other words, get out of that position, and it does allow us to add a second and third and even a fourth position if we really like the stock. But the overall return since inception is at 17.4%. The Wilshire 5000, which is a very broad-based index, over that same time period has returned 11.3%. So you take the one number and subtract the other number, and you get a relative return. You beat the market by 6.1%. That's stellar. And I will tell you that it's very difficult to go out there and find a mutual fund or an ETF that can do the same thing that these 4 amateurs and our whole crew of helpers have helped us do over the last almost 14 years now.
Yeah, that minus 3.1 is the average relative return for the average mutual fund out there. We track about 700 mutual funds and exchange traded funds. That is the average result of those 700. So minus 3%. So it just gives you an idea of the nature of the challenge, and we're just happy to be up where we are.
We also set a goal, an accuracy goal. We would like at least half of our stocks to be winners. They don't have to beat by 5%, but we'd like at least about half of them to be winners. And right now we're at 55%. we did a little bit of academic work, and we studied a book by, it's Rex Tillinghast. That's his first name,
I
isn't it,
think
Mark?
it's Joel.
Joel Tillinghast.
Yep.
Okay. And Mr. Tillinghast suggested that 55% is a very worthwhile goal for a regular individual investor like we are. So we've managed to hit that accuracy goal right on the nose at the moment. So all in all, this is a great report for us to give today, and we just hope to keep those blue dots above that orange line as we go into the future.
Okay, if there aren't any further questions, here's the top 20 holdings of the portfolio, the tracking portfolio that Ken has described. So these are the top 20 by percent of total assets. So Microsoft is the largest position in the portfolio, having been selected by a knight, a damsel, or the audience 5 times. How do we know that? The legend up here tells us Microsoft has been selected 5 times. So $5,000 has been invested into Microsoft. It's now worth over $100,000. So every time we make a decision or a selection, we take $1,000 and invest it into that decision that is made, and then we keep track. So you can decode it using the number of repeat selections up at the top of the chart, and these are the active, currently open positions in the portfolio. The entire portfolio, there's about 70, maybe 80 total positions in the active portfolio. You can find that at this link up at the top of the page. You can follow along there. That is a public link, so you can take a look at that at your leisure. Anything here you would like to point out, sir?
Well, it's just that if you don't find a particular stock's name on this legend up here, for example, Costco is on this list, but you won't find Costco anywhere in the legend. That's because it's only been chosen one time. So that one choice of Costco has turned into almost $18,000 now. That's that's a really nice return, as is this Microsoft return, as is a lot of returns on this list right here. So without further ado, let's continue and move into some new stuff if we can, Mark.
Yeah, I don't want to go too deep into this. We don't really have any strong sell candidates or nothing setting the world on fire. Our overall return forecast is low, but that's because we've done so well over the last several months. Intel is kind of an interesting case of its own, and I'm just kind of laying it out there for a couple of reasons. First of all, the overall growth. I don't care if you draw the line through here. It's just not what it used to be. And I'm a little bit concerned about the tapering off of the quality up here. I think it's something we probably should talk about in greater detail. I don't think we need to do it right now because you are looking at a mid-single digits return, but they've had quite a good bounce. I mean, here's a look at the last few months. So they've had a really nice bounce, but then this report is only a couple days old, and it led to the price action you see down there. So again, they went from 30 to 50 something here, and it's a pretty good hit that they took when the earnings report came out. So I don't know. I think we have talked time and time about coming up with some type of quality degradation. I don't know what word to call it. Decline in quality metric. Maybe it's time to put something together that really makes sense. Any thoughts on that?
That would absolutely, that when quality declines so much that it would trigger at least a look at the stock, if nothing else. The trouble's always been, Mark, that we've decided that a decline from 100 to 90 is much different than a decline from 80 to 70. And we're trying to wrap our arms around the differences, even though they're both only 10 points in decline. They both signify, in my mind at least, different problems that might be happening. So we'll have to do some real serious talking about that. I think Intel, if it can make good on its promise to begin manufacturing again in the United States, I think long term, if it can pull that off, it has a chance to become something quite impressive again. But that's a tall order for it to pull off, and it's not happening right now without a whole lot of side trips and a whole lot of discussion and a whole lot of backwards and forwards as to what's going to happen and where it's going to happen.
Yeah. The other thing that I would say, two comments just looking at this. Again, as Mark alluded to, the 4.2% for a stable, let's go ahead and concede and call it blue chipish, although we could perhaps, given what I'm about to say, debate that a little bit, is not awful. 1.5 sales growth, that's not much if there's other things going on. But notice the earnings per share projections only 2.2. So it's not like they're generating tons of cash that they're using to buy back shares or pay high dividends, or, well, the earnings wouldn't impact the dividends, but again, the total return doesn't have a huge yield, though it is above average. But really looking at the sales growth and earnings growth makes me question. Now, back to the quality thing, I think that Ken makes a good point that a drop from 100 to 90 is way different than I would tend to say even from 70 to 60. Certainly.
Absolutely, Si. I'd agree with you 100%. Yeah.
You know, but even leaving aside, I mean, numerically it's somewhat different in percentages, but our whole theory is that 80 and above is excellent quality, for example. And we have said more than once that there's not tons of difference between that 100 and the 90 or 95 and 90. And really, I think our methodology almost treats not a whole lot of difference even over 80s.
Mm-hmm.
You know, so again, as long as it's in the blue, I don't really see a intellectually honest and consistent quality degradation that you can make based on quality ranking. Now, growth is one of the quality factors, and you might say it's a growth degradation.
Yeah.
And so,
well, and we've always talked also about the fact that if a stock is returning what you can get in fixed income, which is a much safer type of investment than investing in any stock, I don't care what the stock is. And I know that you can get 4.2% for a
yes,
reasonable period of time in very, very safe fixed income vehicles right now. In fact, I can get 4.5% right now in the Hi-Fi savings account at my credit union. So, you know, it's causing some issues in my mind as to what we do with a stock like this, Mark. Yeah.
Yeah, there's definitely some angst there. They have had a nice recovery. It is a single position in the portfolio. Again, I think I'd like to back up and look at it from 35,000 feet, and I would suggest a couple of things. Maybe one, take a look at the Bulls and Bears summary from Morningstar next month when we get together. And then I would also, although she's taken a lot of nasty bad press heat, Kathy Wood has been quite concerned, and I'm sugarcoating, about Intel for quite some time. I'd kind of like to go back and see what she had to say about the company over the last year or so, and how much of it is seeming to materialize. There are an awful lot of good options in the realm of chips out there, and
I agree with you 100%. There's so many different kinds of chips that are available today too. I mean, we can deal with real simple chips like Texas Instruments, or we can go to the extreme GPUs like NVIDIA and AMD are trying to deal with. So
yeah.
we have all kinds of chips out there. We don't have to stick. We're not confined to a single big company anymore as we were maybe 25, 30 years ago with Intel.
Okay, so I've made a note. We will take a look at those types of things, and then also wrap it in that thought process on the quality decline, because they're in danger of dropping out of the good range. So we'll just leave it at that for now. And unless you guys have anything else, we'll just keep pressing on.
Okay, I'm going to give an answer to Milburn out in our audience. He wants to know how is quality calculated, and we don't have time to get into that this evening, Milburn, but if you are a Manifest Investing subscriber, there's a beautiful article on the website about quality, which you can read. And if in fact you need a copy of that article, I think an email to Mark R. at manifestinvesting.com will get you a PDF of the article which describes how quality is calculated.
Yeah, and the other thing you can do is Google Manifest Investing quality, but don't use the word quality, use excellence. Excellence. And that'll take you to that same article. It is available for free on the internet. Okay. All right, so with that, let's dig into our stock presentations. Our labor and delivery nurse is leading us off with PayPal. It's one of her longtime favorites, and she sees the opportunity for a little rebound and recovery. So Kim, take us away.
Okay. Well, full disclosure, I own this stock. I've been watching it. When the pandemic happened, as everyone can see, it shot up and it was $300 a share, and it was way overvalued. But everything's come home to roost since then. And they also had a few little issues with, they found out they had a lot of fake accounts getting on there, and they had to get rid of the fake accounts because they were giving them certain bonuses and stuff. And so now they're trying to, we had a catalyst event that happened because Elliott Management came in and said to the founder, Dan Schulman, you're not running this company well. You had bought a couple of companies and you didn't manage them well, and those integration to PayPal didn't happen well. So you need to do something. And ultimately it was agreed that the CEO would leave, and they got a new CEO. And they got Alex Crisis from Intuit, and he's only been there like 3 months. They have bought back 5% of their outstanding shares. They've been cutting expenses. He's been evaluating what are the different sections of PayPal that they have, and should they keep certain sections or should they sell them off? So they have sold off their happy returns, and they were getting, I think the next slide has it, they got like, let's say $1 billion. They got a lot of money for it. Happy returns got $465 million in cash, giving them greater focus on their core business and strategic properties. This company has still been growing at pretty steady, even though stock price has gone down. This last quarter that they had in November was revenue growth of 8%. They had earnings, non-GAAP earnings of $1.30, growing at 30%. Total payment volumes had grown at 15%. These are all good numbers. They bought back shares, that 5% year over year outstanding, which was $5.4 billion of free cash flow that they used to do that. So they're expecting a lot of good things, earnings to be able to grow about approximately 21%. They got more share repurchases they plan on doing, which is about $4.6 billion of free cash flow. They're generating cash flow. They're still growing. Believe it or not, of all the electronic transactions that are going on, PayPal has 25% of those transactions. So they've been, let's see what the new CEO can do. So next slide. Here's a couple of slides from the third quarter results. So they had transaction growth of 11%. And what the big thing they've been going for is they want every user of PayPal to see if they will increase using PayPal and doing more transactions with them. And they have that. They've grown 13%. So each individual account owner of PayPal overall has done more and more transactions with PayPal. As their total payment volume we discussed, they have increased that. Their revenue was growing at 8% to 9%. Their operating income increased 8%. And this is a huge, huge company, and they're still growing. And they have, what more can you say? They keep growing. All their numbers are good. They've got lots of free cash flow, but the stock price has been slammed. They do have a completely diversified portfolio. They've got the wallet and the commerce. They've got networking, the payment service providers. So they've got all aspects covered. Next slide. The most important thing on a lot of these companies is what is their total payment volume. And they keep increasing. So as Venmo, I'll be the first to admit, probably last year was the first time I started using Venmo, and it's really smooth and easy to use. Even where you say PayPal, Venmo, and Exim increased 4%, that's 25% of their total payment volume. And they're considering whether they may even sell off Exim because it's not really been integrated into their platform well, and that if it's not integrated well, then maybe they'll just need to get rid of it. So the new CEO is doing a lot of good stuff. Next slide. This is the value line from February the 2nd of 2024. My library had it a little early. Mark, your little red pen. Yeah, there you go. I want you to notice the first thing at the PE ratio. These are the things Kim likes to look at. The trailing PE has been 19. What is it now? 16. It's even better. You'll notice that on the price projections box on the left-hand side, you will not buy a stock unless that total annual return is at least 10%. And what do we have is we have a low of 23% and a high of 36. That's kind of where I start going cha-ching. In the middle of the page, Mark, where we have the dotted lines. Notice how in 22, where you have the dotted line above, but the stock price is below. That is really what value line shows by their proprietary network, by their analysis, this stock is undervalued, and the gap between the black dot and the dots is the undervalued of the stock. So if it closed at $62 and change today, and it should be up to about 140, 62 from 140, you got $80. That's 100%, over 100% growth there, that they think this stock could be undervalued. Next slide. All right, I love going down a value line sheet on the outside here. In 2024, they have revenue growth per share of $31.50. If you go on over, that looks at that's over a 10% growth rate at $35.50. And by the way, we all understand that Buffett used to say he used to look at value line sheets just to find a stock that's undervalued. And I think I'm finally getting this. Current flow per share is $5.60 for 2024, but they think that is going to go up almost another 50% to $7.65. Earnings per share, $4.20 to $6.05. Capital spending, 95 cents to $1.35. You have to remember, this is not a capital intensive company. What they have are computers who do the work. So they're able to have a lot of free cash flow. The book value per share, if you look at that, that's like going up 40% in 5 years. Value Line doesn't feel their outstanding common shares are going to change at all. So that'll be something you need to keep an eye on there. The current PE that Mark just circled there was, Mark, what was that, 16.6?
Mm-hmm. Yes.
And they think the PE is going to, average PE in 5 years will be 30. Well, that is PE and expansion. And folks, when you have PE expansion, that means the stock price goes up. You have revenues of 315 or $31 billion going to 35 billion. That's another 10% growth there at least. They've got nice fat operating margins, which are improving and getting better. They're not going down, they're going up. Their net profits is going up. The tax rate is staying the same. The net profit margin is going up. Long-term debt is going down. Shareholder equity is going up. Return on capital is going up. Return on shareholder equity is going up. Folks, we're looking at numbers. Numbers are telling us, by what this value line sheet is telling us, is that the market has not recognized that the stock is undervalued and the stock price is currently depressed. By the numbers, it should be much higher. I have read, because Josh Brown is recommending this stock for 2024, and so is Michael Bachnick. I looked in Morningstar, and ironically, there was nothing even in Morningstar. Value Line, like, they have this out. So everything, I think this company is going to be able to, with the new CEO and the innovations that he's doing, is going to make this company a better company, and it's going to grow more. Now, this just came out as of a week ago, and this way it may be why the analysts don't have anything out there yet. They have 6 new innovations that they're starting, and they're using AI for all of them. With what's going to happen here is the transforming the checkout using PayPal. A lot of people will lag and forget their password or their sign-ons. They're going to make it a pass key so that with one tap, once all your information is in there, that's all you have to do, it goes on through. So they believe that this will increase efficiency by 50%. They're going to use AI with this transforming the checkout to see what else they can do with it. They're also going to make a fast lane by PayPal, and that's going to be used by the merchants, who then they can save all the information that they use in one thing. No username, no password to remember, no personal information, no using a credit card, all that stuff's in there. And the early results have been astounding with the checkout speeds nearly 40% faster. So they're finding a way to have more transactions faster. And when you have these transactions at the merch site, like anytime you go anywhere else, if you use your Visa credit card or anywhere else, you get cashback offers. And these cashback offers are going to be, they've got them with Best Buy, eBay, McDonald's, Priceline, Ticketmaster, Uber, Walmart. So they're using the AI in this way. They're going to use it in their next generation of Venmo business profiles. And right now they have this at 90 million active accounts. And they're going to enhance these profiles by adding subscribe buttons, profile rankings, offer promotions that can drive more traffic, generate more sales, and more meaningful growth, because they're also going to network the AI, that information that they get in, to see what is the customer using, to see if they can give them promotions for what they have been using, so then they can introduce and have more sales. The app is going to get improved to make it easier and more functional of use, and then have more partnerships in it. All of these are AI. all these enhancements, I believe, will make the company even more profitable, and that means more transactions. More transactions is what PayPal wants. All good. Next slide. Now, this is my quick and dirty DCF that I do from the value line sheet. On the cash flow per share, you see $7.65. You subtract the dividends. Now, they have no dividends, minus their capital expenses, which is $1.35, which is $6.35. You take the 28 that is from the legend box on the value line sheet, and you multiply that out. By the discounted cash flow, this stock, they feel, in 5 years could be $177.80. Now, you look at what the 2026-28 projection box says, saying that they think the price will be 145 to 220. Look at that. That discounted cash flow is about exactly almost in the middle of that. At $177, and if our stock price is 63, you don't just have a 100% return, you almost have 190% return. So yeah, I think this stock is undervalued. Next stock, or next slide. Okay, here's the one-liner from Manifest. They think the projection annual return could be 13.3%. Their quality is 85.7. So their margins are good. They think everything's going good there also. I feel PayPal is undervalued, so I hope everyone would consider it as a stock that you will pick tonight. Thank you so much.
Thanks, Kim. Good stuff. All right, well, we will turn to United Health and Ken Kavula.
Thank you, Mark. I don't have a real sexy stock tonight. I have a very large stock. It's not going to triple in value in the next 5 years, but United Health Group is a stock that I've owned for quite a while. I hardly ever find United Health in the buy zone, and it's finding itself in the buy zone, and I'll try to explain as we go on why it's there, at least in my opinion. United Health, many of you see it as nothing more than a company that provides Medicare and Medicaid and private insurance to younger and older people. But United Health Group, which is the basic company itself, has a number of different divisions. I doubt if many people even know that the Optum division is part of United Healthcare. The Optum Pharmacy, the Optum Health System, which is care delivery, it's actual care. And that's all in addition then to the individual types of insurance they offer, the Medicare and Medicaid insurance they offer to older adults and to retired adults, and the state and community programs that United Healthcare runs for governments throughout the country. I use the SSG for United Health as a teaching tool because when I'm talking to novice investors, up, straight, and parallel is an extremely important concept to begin the journey of learning about better investing. And United Health is one of the best examples of up, straight, and parallel that I can find anywhere in the stock universe. Next slide, Mark. United Health has 5 strategic growth priorities. I'm not going to read these to you. They have quite a complete presentation on their website, an investor presentation. If you're interested in United Health and what it does and how it does make money right now and how it's going to make money in the future, I would urge you to go to their website and look at their investor presentation. It's written in simple, plain, straightforward English, and I think it will explain to you how this very, very, very large, relatively complicated company is going to turn dollars into profit. You see the kind of growth they're expecting in the next 3 or 4 years for each of these particular priorities. That's the third column in the graphic that you're looking at right there. And you get the idea that the numbers are huge when they're talking about different types of goals and priorities for growth. In health technology alone, they're looking to add about 23 billion electronic transactions to the 285 million lives and clinical data claims that they have track of at the particular time. That's just one example. Let's do the next slide, would we? I've taken from Value Line the annual rates box, and I'm pointing out that revenues for Value Line's point of view, 3 to 5 years in the future should be by about 9.5%. Earnings should be going at about 13%. Value Line seems to think this is an A++ financial strength company with a safety ranking of 1. Those are the two numbers that I look for when I'm looking for the different variable numbers that Value Line puts in the upper left-hand corner of their report. The timeliness number is a short-term call. Please remember, when you're reading a timeliness number, you're reading a number that's probably estimated to be happening somewhere 9 to 12 months into the future. From Morningstar, I pulled a paragraph off of the initial paragraph in the analyst report. The firm itself, the company itself, is predicting earnings growth of 13 to 16% in 2024. Morningstar indicates that they're comfortable with a forecast mildly above management's outlook. Those are certainly optimistic numbers for a huge company. Manifest Investing, that relies on Y-charts data, is calculating a par value of about 11%. Remember that a really good, solid, huge company could be expected and could be considered to be doing quite well if it returns something in the neighborhood of 6, 7, 8%. So we have an 11% par for United Health Group, another indication that it might be undervalued at the moment. Manifest is predicting sales growth very, very close for its 5-year call to what Value Line predicted. Value Line said 9.5. Manifest's Y-charts data is giving us a sales growth number of about 10.2. Those numbers are close enough to be called the same. So we're getting good, solid, correlating data that we can do a pretty straightforward SSG from. Next slide. There's the reason that I use this as a teaching tool. Those lines are certainly up, they're certainly straight, and they're certainly, especially in the last 6 or 7 years, they're certainly parallel to each other. And the projections, that's the dotted lines off of the end of the 23 fiscal year there. The projections are at 9% for sales growth and 11% for earnings growth. When you compare those to the numbers I was just talking about, you can see that my analysis is coming in on the conservative side of where the average call is being made. Next slide. I like to pull this chart up and take a look at how many quarters has the company been able to match or exceed the calls that I've made in sales and in earnings. It's kind of a messy graph, but if you look carefully, you'll see a horizontal blue line and a horizontal green line. The blue line represents the call of 11% earnings. The horizontal green line represents the call of 9% sales growth. And you can see every dot is a quarter. And you can see for the last 7 quarters that both earnings growth and sales growth have been above my projections. We have to go all the way back to the March quarter of 2022. Most of you remember what was happening at that quarter. And you have to go all the way back there before you get one of the two values to fall beneath the projections that I'm talking about. Next slide. Here's section 3 from my SSG. I'm looking at the high PE column, that's column D, and the low PE column, that's column E. I'm finding the numbers really for a data set that's a nice closely bunched set of values, and that just gives me a lot of confidence that I can trust the averages going forward. I get nice closely bunched numbers at both sides. Folks, please resist the urge to strike the 21 in the low column just because it starts with a 2. If the average is around 17, then 21 is 4 above, 11 is 6 below the 17. That's a closely grouped bunch of numbers, and that 16.7 or 17, I think fairly reasonably represents that low PE value. Next slide. I also am looking at column G in section 3. That's the payout ratio. And again, this very large company, we see that the board of directors has decided what they'd like the payout ratio to be. I would imagine if we were privy to the minutes of the board meetings, somewhere in the minutes, we'd find a discussion about keeping the payout ratio somewhere around 30%. We have 5 years of past history to kind of verify that. Up in the upper left-hand corner of your SSG Plus, notice that recently you've been given the option of switching from 5 years to 10 years of data. And for those of you that are novices, I would urge you to hit that button and look at the last 10 years. See what's been happening, especially because in the last 5 years, we've had this extreme disruption of the pandemic, and we might get a little bit different picture if we look at 10 years rather than just last 5 years. I'm going to use 31% as the payout ratio for my calculations. I think it's reasonable, but I'm not going to argue with somebody that would like to use 30 or 29 or 32 or 28. Next slide. Here we are with the forecast high price of about $9.25, the forecast low price of about $4.05, and the current price as of Monday night of about $5.04. That's in the buy zone with about a 4-to-1 upside downside ratio. I will tell you that I have owned United Health probably for 12, maybe 13 years, and I hardly ever find it in the buy zone. I have been wanting to buy more United Health for years. It's been at the top of my please buy if it ever moves into the buy zone list. It's a lot like another stock that I finally was able to buy about a year ago, and that was Costco. These kind of real consistent, steady growers over really long periods of time hardly ever go on sale. Why is United Health on sale? Here's my thesis. Humana is a direct competitor to United Health in part of United Health's business model. Humana is an insurer that provides Medicare options, Medicaid options, and insurance for people that are presently working at a regular job. Humana had some real problems with increasing costs in medicine when it reported its earnings about 9 or 10 days ago. What happened to Humana's stock price was it took a big hit. And as happens in the stock market quite frequently, for no other reason besides the fact that it operates in the same general industry, United Healthcare also took a hit in its stock price. It moved, and they say, in sympathy with Humana, and my explanation is people were throwing the baby out with the bathwater. They weren't doing their homework. They didn't realize that the overlap in business models was not complete. Humana is not just a different name to the same company. Humana only does part of what United Healthcare does. Much of United Healthcare's business is outside the realm of insurance. I think it's undervalued. I think it's a great stock. The size of the company alone would lead me to believe that I should expect growth of 7 or 8% at best. Instead, I have a stock right now that I can stand to make, by my analysis at least, somewhere between 11 to 14% on. Included in that 11 to 14%, 1% of the appreciation is coming from the dividend itself. That's not a big dividend, but it's a dividend that should be mentioned. It's a good, solid 1% coming from the company directly. I feel that it's a very large company. It's attractively priced. And again, my experience is that this stock that I own, that I really like, and that is just about as perfect an up, straight, and parallel example as you can find, it hardly ever signifies itself as a buy. I own the stock. I've added to my holdings, and I ask you to add at least $1,000 to the holdings of the roundtable and to consider it maybe as the audience choice. Thanks a lot.
Just flat out lobbying. Cool.
Lobbying.
All right, so let's switch gears to another medical related stock that Silence is going to share some thoughts on.
All right. Thank you, Mark. And good evening, everybody. Here is the front page graph of the stock selection guide for INMD Limited. A couple of things about this company. You'll see that the history is relatively short. The company's been around since 2008, but it went public in August of 2019. So that's where the market data started, and you've got financial data 2 years prior to that. Notice I've also added a line, which there are various optional lines on the SSG Plus tool of free cash flow. I don't watch cash flow generally for just, in every company for every reason. There may be a specific reason. But in a smaller company like this with sales of just under 500 million for 2023 with relatively little history, I like having some double checks. And one thing that is good to watch is cash flow. And technically it's operating cash flow, not free cash flow, but operating cash flow is even higher. It's a higher number than free cash flow. But you want to see the operating cash flow exceed earnings per share. It's just a double check on the quality of the earnings. And here you could see free cash flow per share has consistently exceeded, that's the purple line, consistently exceeded the blue line since the company has been reporting. So that's just a good assurance of the quality of the earnings. And then I'll be talking a little bit more about the meanings of Ozempic and Wegovy and aging like milk as we go on tonight. But INMD is in the medical device business and deals with devices largely in aesthetics. And so we'll see what those things had to do with it. Next slide.
Okay, no cow tipping.
No cow tipping. All right, I'll try not to. The way that I found INMD INMD tonight was I decided to leverage the power of our community, specifically the Better Investing community. And there is a tool, screening tool or informational tool in the SSG Plus that we have that shows the top 100 tickers researched in the last 90 days. And I was interested in healthcare. And you see that INMD the size of the square is the number of studies, and the greenness of the square is positive sentiment. The kind of yellow and orange are in the neutral areas, and as you get more red, it's negative sentiments on this heat map, it's called. But INMD was the most studied in the last 90 days in the healthcare industry. So I said, let's take a look at it, because obviously the community is interested, and the green indicates positive on it. So let's continue. And I believe it was fairly popular with 2023 groundhog people as well. So
it was.
It expands into the manifest community as well, which of course that's not terribly surprising given the overlap between the communities. But INMD is a medical device provider that seeks to harness radio frequency, RF, and have minimally invasive surgical procedure devices, principally for aesthetic or, very bluntly, fat manipulation and dealing with adjusting fat levels in our body, and also skin coverage. They seek to fill the treatment gap between traditional lasers, which are largely non-invasive, and full surgery. And they say that the aesthetic industry is undergoing a paradigm shift into these RF sort of devices and past lasers, and they're seeking to seize that opportunity. Next slide. Like Ken mentioned, I pulled a lot of the slides from the investor presentation on the INMD site. I encourage you to go look there. Here is a slide that just describes that treatment gap that I was talking about between the laser procedures and traditional plastic surgery. They're looking for people in the 35 to 60-year-old range, which doesn't quite hit my aging like milk, but aging like milk Gen Zers will be entering that age group at some point in time. And you can study this slide and read it on your own. They're just seeking to bridge that gap with the non-invasive RF radio frequency technology. Next slide. And here is the paradigm shift. You see on the left-hand side, traditional laser-based aesthetic companies, some of whom the officers and directors from INMD have come from. And then INMD is minimally invasive radio frequency. And so that's the paradigm shift. And there's some more discussion of this in the presentation that's beyond what we want to get into tonight. Next slide. This is just a quick overview of where the company has offices. They're headquartered in Israel. That's where they're based. Most sales come from the United States, and their manufacturing is throughout the world, and they have sales forces throughout the world. Next slide. Here's the potential market, who they serve. They serve surgically trained physicians in the U.S. and globally. And as they note, not all of them focus just on aesthetics, but they perform aesthetic procedures. And remember that there are aesthetic procedures are what I might call vanity procedures, where we just want to look better for our own ego sense, if you will. But there's also aesthetic procedures that relate to some other medical condition that goes beyond simply a patient's, let's say, vanity. It still helps the patient's self-image as they feel that they look better to themselves and to the world. But aesthetic isn't purely a vanity area, and INMD doesn't serve just aesthetic procedures. They also have some OBGYN menopause treatments. They're developing eye treatments for dry eye, erectile dysfunction treatments for urologists, and some other things beyond the aesthetic area. Next slide. These next 5 slides, they just highlight in this report what they call their 5 proprietary technologies, principal technologies. RFAL is one that is, let me grab my notes here and I'll tell you exactly what that stands for. Radio frequency assisted lipolysis, which that is going beneath the skin into the subdermal areas and impacting the skin and the fat layers. And you can see discussion there. And the big deal, they call it holy grail of plastic surgery, that you can have face and body results without large scars. Next slide. Deep subdural fractional RF, that's just going deeper into the skin layer to again impact the skin and improve the tightness of the skin. Next slide. Here is their what they call their Evolve, and this is a hands-free. These treatments don't need to be manipulated by the surgeon or the technician. They're just placed on the body and treat. Next slide. And then special, this is their higher level facial treatments. And again, seeking to avoid surgery and pursue more natural looking results. And again, much of these deal with the eye area, eyelids and the like. Next slide. And then some additional technology that they're showing here. This is their highest level of their technological development. And again, they go into more detail on each of these devices and technologies in the report. Next slide. Here is their attempts to market to doctors. They have 95, more than 95 peer-reviewed publications about the use and the efficacy of their treatments. And again, you notice skin tightening, talking about liposectomy, traditional suction, sort of removing or remanipulating fat layers. That's what their processes seek to do. And again, the reason we mentioned Ozempic and Wegovy, and you have other of the diabetes weight loss drugs that are really taking the world by storm, if you will. Trulicity, Rybelsus, or others, GLP-1 drugs, and there's another class that do very similar weight loss assistance. Farxiga and Jardiance are examples of those. And what patients are finding and doctors are finding, that when patients lose significant amounts of weight, they are left with loose skin. And that's the market that INMD is dealing with in the aesthetic area. Also, I happen to mention aging like milk. If you follow social media or even just reporting on social media, you may be aware that there's kind of an ongoing duel right now on YouTube and TikTok and those areas between millennials and Gen Zers, that is between 20-somethings and 30, 40-somethings, over the Gen Zers being very obsessed with their appearance and feeling that they are aging faster than everybody else. And, that's not unusual for a generation that is digital in nature and is all about appearing in selfies and on social media and the like. And that I think that trend of those people moving as they age, as they get older, as they accumulate more resources and can spend, that's more potential market for INMD. So next slide. This is just their history, which we've seen some on the stock selection. Got very high profitability, and they also are tax advantaged given their location in Israel and in some tax advantaged places. There, next slide.
Cy, I have to interrupt you because we have somebody that wants to know if you've tried any of these things yourself.
Not yet. Not yet. I have not. I'm still seeking my Wegovy Ozempic weight reduction prescription, and then maybe I'll.
Well, you know, while I've been working on my core, you know, as you've seen in some of those leaked photos, I'm looking for that chiseled jaw for when we
There you
arrive
go.
at Bink. So a chiseled jawline
There.
is now possible. All right.
Absolutely. There is hope. I should have mentioned boomers. Don't need just Gen Zers. But here are my judgments, and this is this is a company that is moving from explosive growth into a more maturing yet still solid growth company, and I'm projecting sales growth at 11%, which is right in line with the last year or so, but well below that 50% plus that you see for the last 5 years history. My profit margin, I've just used the 5-year average of 38%. Profit margins are significantly higher right now, but again, given the history of the company, let's see how margins shake out. If they're higher than that, we'll be pleasantly surprised. Shares have been very steady, so I'm projecting them to stay the same, but do notice that I've given them a bit of a tax break based on management's projections of 7 to 10% going forward. And all of that leads me to $3.37 EPS 5 years from now. That's right in line with the median projection of those 802 better investing community studies and a little below the manifest consensus. And then last slide for the bottom line. Using a high PE of 25, the stock could return 28%. Very healthy return over the next 5 years. Again, INMD has suffered because of the beat down in the market, I think, on medical device generally. Also, they took a bit of a hit when the Israeli Hamas war started, although, again, they don't anticipate significant disruption to their operations. Again, 1% of their sales are in Israel, and much of their presence is outside the nation. And then using average PE, still an 18. So it's a fairly wide range because this is a newer, more volatile stock, but it's a very attractive, well above market potential return. So I'm going to add $1,000 to the tracking portfolio and think that you should consider adding an additional. Let's get a little frisky and tight and slick together.
Tighten up.
That's right. Tighten up the portfolio.
All right. Thanks, Cy. Here, just a quick reminder.
This is Kim. Just for 1 second, I'd like to say thanks, Cy, for having PayPal in that nice, lovely green color in that slide.
There you go. All right. Just a quick reminder that Ken and I have been doing a demonstration, real money portfolio. We're calling it Buttonwood during the bull sessions. They're Tuesdays at 2. If you have questions about that or would like to know more about it, reach out to us. All right. Well, here's a couple of places that I went searching for candidates. I'm actually using the Kurt Kowitz approach here. When you go into Manifest and you begin to do research and you simply do the company pull down tab, Kurt actually loads it or preloads it with a bunch of companies that are going to qualify with decent return forecasts and excellent quality. And as you look down that list, I think you find a number of companies that we've talked about quite a bit recently that probably offer pretty good potential for studies. Getting a lot of groundhog traffic on, this is an old Ken Kavula favorite, Inter Parfums from many years ago. You may recall that, Ken.
We just added this one to our pounce list in the Wolves Club last night, Mark.
Well, there you go. So there's a number of companies here that trigger some interest. Humana, for the reasons that Ken mentioned a few minutes ago, is in kind of a dust up situation. So we'll kind of set that one aside. I'm going to use this one as my company for tonight, Monster Beverage. And I wanted to sneak these guys in to say that we are greatly relieved that since Halloween, our best small companies are not doing too badly. And I always go looking on this list for companies that have had a little bit of a setback. They're the ones that would be towards the bottom of this list. And I actually have been doing a little bit of shopping down here amongst these that have been a little bit more lackluster that may still have interesting stories behind them. I find Neogen interesting. Longtime community favorite, especially here in Michigan. The integration and transformation with 3M is going pretty nicely and probably not reflected as much as it could be. So that would be a good study. And InMode was the other one that's trading near its 52-week low, and Cy already took care of that one. So we'll just move on, unless you have any objections, Ken.
Nope.
All right. So it comes down to this Monster Beverage Company. And my rationale here is actually fairly simple. Kevin picked it a few months ago. And back in August 2023, he actually did most of the work for me. You can actually go back and watch that presentation on YouTube. But if Kevin liked it at $58.49, I got to really like it now down in the mid 50s because it's actually gone down a little bit while the market's gone up. So, you know, he's treading water here a little bit. But if I lock it in down at this $54, $55 range, I will always be ahead of him on future updates, and he can't catch up. So that's the kind of the real motivation behind it. And the other reason is that with this beverage, it goes really well with the Portillo's hot dog. So it's just a slam dunk winner, guys. I don't think we need to do any more here, do we? All right, we will do a little bit more. Here's a quick look at the visual analysis. First of all, the quality of the company is very high. These guys are a juggernaut in the beverage, non-alcoholic beverage industry. You saw all those cans up at the top. They sell a bunch of this stuff, and very high quality company, very, very profitable, very, very steady. You can see up straight and parallel. The sales growth is, you know, trucking right along in the low teens. The profitability is very strong, very steady, and stock price follows earnings over the long term. We like that so long as we can get the company at a decent price. And, you know, it's running in the low teens as far as price goes. I'd like to have it a little bit higher with respect to return forecast, but hey, it's better than it was at $58 or $59. So again, this is near multi-year highs. So with that, we are going to add $1,000. Second thing, Kevin's motion from August, and add another $1,000 to Monster Beverage.
Okay, so you're ready for our poll then, I assume, right, Mark?
I am ready for the poll.
Here we go. We're launching our poll.
It is fascinating while you guys are all voting. It's fascinating to look at all the various social media stuff that these guys are doing. It's really pretty cool when you see the amount of impact they've had in a number of sports and all that kind of stuff. In fact, Kim, there's a huge following in esports with these guys.
Oh, yeah.
From Monster Beverage. Just an amazing number of programs.
We have more than 2/3 of you voting. We'd love to get up to around 90% if we could. We just went to 3/4 of the population voting. So let's get that number up to 90 if we can. Okay. There's it. It's at 80. We have a nice audience this evening, so it takes a few more votes to move the percentages up. I'm going to have to settle for 85%, and I'm going to count backwards to 10. If you haven't voted, now's the time to get that vote in. Okay, and I'm going to close the poll, and I'm going to share the results. And it was a close vote tonight, Mark. We don't normally have close votes. We have 39% for PayPal, Kim, and 31% for United Health, InMode at 20, and Monster at 8.
Well, Ken, I would like to suspend my election run here and transfer my delegates to. No, I'm just kidding. Just kidding.
All right. Let's not even go there. Okay?
No, it doesn't seem right. All right, can you switch it back to?
I'm attempting to right now, but my button wasn't working. There we go. Okay.
I think we're coming back. Let me see.
We
There we
can
go.
wind it down now, Mark. Yeah.
Okay, just a couple more. Just a quick reminder. Ken mentioned it earlier, but if you go to YouTube and you search on Manifest Investing and throw in the word roundtable, we do archive all of these sessions, including our weekly bull sessions and the roundtables. You can go back and look at Kevin's August 2023 presentation on Monster Beverage. And we put all of these presentations here, including our special series, educational series. All right, here's your reminder that not during February, but the February roundtable will actually take place on March 5th because of some schedule conflicts and we had to do some shuffling. And I had forgotten, Ken, that Portillo's was on the cover slide for last year's February meeting. That is our black tie event with the Roundtable Golden Knight Awards, and save the date, March 5th, 2024. I think that's pretty close to when the actual Academy Awards come out. Probably a couple days before that, sometime in that time frame. All right, here's some others. You want to take us home, Ken?
Now, wait, Mark, if you can hold on just a second. I'm confused on that slide because you have a date of February. Oh, that's 2023.
That's from
okay.
last year's date.
Oh, that's from last year. Okay.
This is the date. Everybody saved
It's
that
been a
date.
long day, Mark. All right. March 5th, 2024. Got it. Okay.
Although we'll probably reuse that cover slide because we've got that wonderful group of knights and damsels all on proud display there. All right. So here's the rest of our stuff for the next couple of months. Ken, we do need to iron or nail down those dates on the Successful Investing Conference.
The dates are nailed down. We need to get the times nailed down now, Mark. Okay. Those dates Natalie has started to publicize, right?
So what that will be for everybody out there is probably a 2-day event where we have a series of probably 3 educational sessions on a variety of topics, and then we have a panel session of much like tonight, but with a slightly different spin to it. And we've had some pretty interesting stocks like Immunogen from 3 years ago presented at conferences like that. So that's there. Ken and I will be in Troy, Michigan for a face-to-face meeting with the Southeast Michigan chapter on April 20th, 2024. That's a couple hours on a Saturday morning and should be some good, clean fun. Our April roundtable will be presented jointly again this year with St. Louis. That's on April 30th, 2024. And then the National Convention is in Chicago from May 16th through the 19th. And I don't think I missed any big ones there, but if I did, let me know. And Ken, correct me any place that I need to be edited.
And if you're in a chapter that we can drive to, Mark and I are doing face-to-face events. We really miss them, and we're doing face-to-face events again. So if you're looking for something face-to-face and you're within driving distance, we'd be glad to come to your chapter and present. We're pretty cheap, so give us a try. But you do get what you pay for, though, so watch out, okay?
Ken, we are
I-
getting a substantial amount of nibbles from the Pittsburgh / Punxsutawney area, so just be
Okay,
advised.
great. Terrific.
I
Okay.
was going to say I've heard that Shanghai, China is interested in Chinese pork presentation as well.
You betcha they are.
I'll send them a PDF, okay? With all that, let's wrap this session up. Thank you so much for coming. We had a wonderfully large-sized audience tonight. Thanks again for being here. And we kept up with the questions pretty well. So unless I see any more questions suddenly appearing in the questions box, I'm going to assume that we met your needs, and I don't see anything appearing. So I'm going to say, on behalf of Kim and Cy and Mark and Matt, I'm going to say good evening to you all and see you at the next roundtable.
Happy Groundhog's
All
Day,
right.
everyone.
Yes. Thanks, everybody. Good night.
Night, everyone.